Have you ever wondered what it takes to close a $4 billion real estate investment trust deal? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a significant move within the Canadian real estate market, a Singapore sovereign wealth fund and a Canadian multifamily landlord have joined forces to acquire a residential real estate investment trust, or REIT, for a staggering $4 billion. According to Law 360 Real Estate Authority, this acquisition marks a substantial investment in the Canadian residential sector, highlighting the robust interest from international investors in the country's multifamily properties. This deal underscores the growing trend of global investors looking to Canada as a stable and attractive market for multifamily real estate investments. The partnership between the Singapore fund and the Canadian landlord illustrates the strength of collaborative ventures in seizing lucrative opportunities within the real estate landscape. While details about the specific properties involved in the acquisition remain under wraps, the scale of this investment speaks volumes about the confidence these entities have in the Canadian market. It's a testament to the resilience and potential for growth within the multifamily sector, even amidst global economic uncertainties. As we continue to monitor developments in this story, it's clear that such high-profile transactions could pave the way for further investments and partnerships in the Canadian real estate market. This is especially significant for regions like Ontario, where cities such as Hamilton, Niagara, and Burlington offer promising opportunities for multifamily investment. In British Columbia, a new wave of real estate development trusts, or REDTs, is tapping into a broader base of small investors to finance large-scale projects, particularly in the multifamily sector. According to Jamie Mackin, a recent successful offering by Anthem Properties Group LT raised $82 million for a mixed-use project in Burnaby's Metrotown, highlighting the potential of this financing model. The project, known as Citizen, will feature 372 condominiums, 200 market rental units, 73 non-market rental units, 176 hotel suites, and retail space, with a minimum investment requirement of $10,000. These REDTs are opening doors for individual investors across Canada to participate in real estate development by making minimum investments from their retirement savings plans through financial advisors. This model allows individuals to invest alongside institutions, potentially democratizing investment opportunities in the real estate sector. However, it also carries risks due to the nature of the developments, which are often tied to regulatory, construction, and market uncertainties. According to Sur Somerville, a professor of real estate finance at the University of British Columbia, while REDTs give individual investors access to development profits, they come with significant risks. These include the challenges of executing individual developments and the uncertainties associated with them. Unlike traditional real estate investment trusts, which typically involve existing buildings with established rent rolls and tenants. Despite these risks, REDT offerings have found success, with Anthem's project in Burnaby being a prime example. Anthem's chief financial officer, Rob McJunkin, noted that the REDT model was innovative and provided the best opportunity to secure the necessary equity for the project, especially given the current challenges in the market, such as changing government policies and fluctuating costs. Looking forward, North Vancouver-based Pure Multifamily Group is planning its own REDT for an education housing project in Surrey City Centre. This project, in partnership with Global Education Communities Corp., aims to create a $330 million education megacenter featuring a mixed-use tower with market rental units and retail space. The REDT is expected to offer competitive yields, attracting both institutional and retail investors. While REDTs are not seen as a primary solution to the housing crisis, they could contribute to increasing the supply of good quality housing over time. As Pure Group's CEO Steve Evans suggests, any method that can finance and bring more housing supply to the market will have a positive effect. In a strategic move to capitalize on the demand for industrial space, Montreal-based developer Rosefellow has acquired a 1.2 million square foot portion of the mega center Notre Dame in Laval. This acquisition, valued at $75 million, is set to transform the site into a state-of-the-art distribution and light industrial complex. The project, which will see a total investment of approximately $200 million, will include the development of 550,000 square feet across 3 new buildings. According to Don Wilcox, managing editor of Real Estate News Exchange, Rosefellow plans to begin demolition of the existing retail center once current leases expire and tenants are relocated by the end of the year. The remaining portion of the megacenter will continue to be operated by current owners RioCan Real Estate Investment Trust in Hardin. Co-Chief Executive Officer of Rosefellow, Mike Jaeger, emphasized that the decision to focus on industrial use was driven by the high demand for such space in the area. The site, located along Highway 13, offers exceptional visibility and access to the regional transportation network, making it an ideal location for industrial tenants. Despite rising overall industrial vacancy rates, Jaeger remains optimistic, highlighting that Class A industrial space with over 40-foot clear heights has a vacancy rate of just 0.2%. "We don't have any tenancies now, but the plan is we are building on spec," Jaeger noted, expressing confidence that the facility will be fully leased by the time construction is completed. The new development will benefit from its proximity to a range of amenities, including retail outlets, restaurants, and fitness centers, which are crucial for attracting tenants. Jaeger pointed out that the availability of a large labor pool in Laval is another significant advantage for the project. Rosefellow is committed to incorporating sustainability and energy-saving features into the buildings, targeting at least LEED Silver certification. The project is expected to be net zero and could include innovative elements, further enhancing its appeal to environmentally conscious tenants. Co-Chief Executive Officer Sam Sumas expressed enthusiasm for the project, stating, "Laval is an exceptional market that is constantly growing. This strategic acquisition represents a major step in the development of our activities in Laval and confirms our commitment to long-term investment in prime locations." With plans for about $450 million in investments in the area in the coming months, Rosefellow is set to significantly contribute to Laval's economic vitality. This redevelopment project not only highlights the company's commitment to sustainable development, but also underscores the potential for growth in the industrial real estate sector. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.